You have an exam coming up this week. On Wednesday, when we finish in here, I will shut everything down and open up the exam. So if you want anything off of Canvas, make sure you get it off of there Wednesday before class. All right, so say Wednesday at 2 o'clock, make sure you get it off there because as soon as we wrap up on Wednesday, I'll shut it down. I'll open up the exam, and you have the rest of Wednesday, and you have all day Thursday until midnight to take the exams. Don't be tricked. That first big window that you had was because of July 4th, and because I figured some of you were traveling, so I didn't want to be too much of a fill in the blank, and close the exam on Friday. Okay, so that's why I did that. That's why I did that for you guys. But this time, you have Wednesday, Thursday. I will post the grades Friday morning, and that gets us into the last section of the course on Monday. The exam, when you take the exam this time, I believe what's going to happen. This is what I intended to happen. We'll see that if the software works the way I think it works. But this time, when you take the exam, when you submit your answers on the exam, all you're going to see is your score on the exam. Okay, so you're not going to see any detail about that. And if you want to see that, then you'll need to go get with Nicole, which will be on Monday. So we'll do that on Monday. The reason for that, the short version, is that in web courses, I used to be able to set exactly what you could see and what you couldn't see. I had like 8 options that I could choose from. With Canvas, it's all or nothing. So it's either you get to see everything or you get to see nothing. And I don't like it, but it's what I have to work with. So that will be the way for this exam, and probably for the final as well, assuming this exam works the way I think it does. Tony.
Last exam, the link for the Excel was only on question 1. So like when working through, you get down like question like 20 or something, and it's like, so then you want to go back up and go check the Excel. You like scroll all the way back up to question 1 and click the link. Is there any way to have that link on every question?
Why don't you just keep it open?
It won't let you keep it up. You have to go back and forth between the Excel and the.
Not sure.
Huh? Did you have to open on the? Like I didn't have like a minimize window at all on the bottom. Oh wow. Okay.
Yeah, and you can even you can even save it on the desktop. I don't think they like you doing that over in the lab because when you leave, it's still saved on there. So what they ask is that you just open it, and then when you get out of the exam,
I guess I opened it through Lockdown browser.
Actually,
what's that?
I guess I opened it through Lockdown browser, which was the issue.
You can. My understanding is you can't access Excel in the Lockdown browser. So I'm not sure. I'm not sure what you did, but it sounds like you were the only one that did it.
Just going
No,
back
because I went
and
over.
forth question 1 every time.
Yeah, no, because I went over, and that's why I was using Olga as my guinea pig last time. Because that's why I like to go over and actually look when someone's doing it to make sure everything's working right. So all the questions open up at the same time, and you've got the Excel database there. And that's what nobody else experienced that, right?
no, I had the same issue. I don't even know
Okay.
what the problem was though.
So just 2? Okay, so I don't know what y'all were doing, but the bottom line is that you can keep it open so you don't have to keep going all the way back up.
I mean, I just didn't have a bottom bar, so I couldn't like switch in between. So it was like, anytime I wanted to go to Excel, I had to go through the test. Get
Yeah.
it.
No, it's not. You did something wrong. I'm not sure what it was, but you did something wrong. Other questions? Other questions?
Just a comment for his. I think what I had asked just when I was up at the desk,
Yeah.
I was like, I have a special, I'm not supposed to go through Lockdown browser. They were supposed to have an icon that looked different than
Well, yeah.
web browser. So
Yeah,
they may have been
that.
sitting at a different one that didn't have no icon. It
No,
said
because if they went
44.
into Lockdown browser, they wouldn't have been able to access Excel. Which is-
I think I did. I mean, I don't know, because I went through Lockdown browser, but then I just clicked the link to Excel, and it like transferred me through.
Because my icon actually said 44, 53.
Well, again, my understanding, I mean, I haven't gone over there and tested everything this thoroughly, but my understanding is one of the points of Lockdown browser is to keep you out of Excel, right? That's what you guys have experienced in other classes?
It's supposed to keep you out of
Out of everything,
window.
to include Excel. And that's the whole reason that you have that extra icon on there. In any case, it sounds like only 2 of you have the problem, so if it's still a problem, let me know and we can walk over there and see it. And I know there's at least one person taking the exam right after class, right after we finish on Wednesday. So I'm going to walk over there at that time to make sure everything's running right again. So if you want to join us, you're welcome to do so. Other questions? Other questions? Okay. Then let's go ahead and continue. The exam will definitely cover chapters 5, 6, and 7. We'll see how far we get into chapter 8 on Wednesday. So today we're planning on going through chapter 6, which I don't know how long it'll take. But we're going to go through that today. I want to make like I told you on Thursday, I'm embarrassed to even cover time value of money with you guys. But I do want to call your attention to a couple of things about chapter 7, because one of the purposes of going to a university is that you get different views of the world from different professors. So I probably emphasize a few things that others don't, and vice versa. So I do want to call your attention to a couple of things in chapter 7, but the bottom line of chapter 7 is it's time value of money. All the calculations that you can do on your calculator, make sure you can do them on Excel as well. All right, I've given you a whole bunch of example questions that we'll look at the end of class today, unless it spills over into tomorrow. Okay, so today finish up chapter 6, 7. We'll start homework tomorrow. See how long it takes us to get through that, and then we'll see how far we get through chapter 8. Okay. All right. Questions. Questions? Okay, then let's go ahead and continue into chapter 6. What we were doing last week was really an introduction to forecasting, or just talking about forecasting a little bit. We will revisit that in the investing section of the course, so we'll be getting back to that probably towards the end of next week with respect to investments as opposed to corporate finance. But one of the things that I emphasized way back at, I believe it was on the first exam, with your debt-to-equity ratio. Okay, one of the things that I was emphasizing back then is that debt-to-equity ratio, which indicates leverage, which means your business is more risky. Okay, well, one of the things that I mentioned back then, excuse me, was that we would want to employ, exam question, when would you want to employ leverage? Final exam review. Maybe this exam, but one of the next 2 exam reviews. When would you want to use leverage?
When you're growing.
Yeah, when you're doing better, when you're growing, when you expect good times. Okay, it used to always crack me up getting cold calls from stockbrokers. Who would call me just swearing on their mother's life that this stock was going to double over the next 12 months. Okay? Well, if you really believed that, well, let me say that another way. To the extent you believed that, you would be loaded up, you would be using every piece of leverage you could get. You would be borrowing every dollar that you could get your hands on, even at an 18% credit card rate, because if it's going to double, 18% is certainly worth it. And you'd also be loading up on options. Okay? The reason options work the way they do is because of leverage. Okay? So when we want to use leverage is when we're expecting good times. Well, how do we know when we're expecting good times? That's the forecasting. Okay? If our forecast stinks, then then there's nothing we can do. Okay? So that's what that was about. And again, I emphasized this last week. The important part of that wasn't so much the forecasting technique itself, because that's what we're all trying to do. We're all trying to develop a forecasting technique that's 100% accurate. Okay? You're never going to get there, but we want to try and get as close as we can. So we're all trying to do that. The main point was the performance evaluation tools that we looked at. That supplemental information, the mean absolute deviation, root mean square, and the linear regression, the R-squared. Okay? That was the main point of that, to at least introduce you to trying to figure out whether or not your technique's any good, or whether one is better than the other. Okay? So that was the main point of that. Chapter 6, we're getting into a different source of leverage, and you'll notice up here that I call this a reminder from Fin 3403, because I would be shocked if you haven't seen this in at least one other finance class, and I know they used to cover it here on 3403. I do. I'd be shocked if they still didn't. But Chapter 6 talks about degrees of operating, financial, and combined leverage. Okay? What's the source of these leverages, these different leverages? I mean, there are differences between them, but at the end of the day, what's the common denominator? What's the source? Review. And leverage is a crucially important concept. For those of you who want to start your own business, even if you don't, but particularly for those of you who want to start your own business, this is critically important. And if you don't believe anything else I've said this semester, you can believe that.
They'll have a multiplier effect on the net income?
Okay, well, and that's what the leverage is, okay? So all of these leverage for a given change in sales, basically, how do we expect other parts of the income statement to change, okay? But there's a common denominator among these. I thought I saw another hand. Go ahead.
Return earning?
I'm sorry?
No, not return earning. Return on equity.
Now, the common denominator here are fixed costs. Fixed costs. With operating leverage, we're talking about fixed operating costs. Financial leverage, we're talking about fixed sources of financing costs. But the common denominator here is fixed costs. Okay? So the more fixed costs you have in your business, the more leverage you have in your business. Okay? And before I remind you of the math, that should be intuitive. Okay? Because if you go start your business and you're sitting on $10,000 a month in rent payments, okay, well, it should be intuitive that if you're not selling very much, that's going to hurt. But if your business takes off and you're making more and 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 more, and you still only have to pay $10,000, then you get to keep what you make, as opposed to having rent payments that are variable in nature. Good luck actually orchestrating that deal, but assuming you can do it. Okay? So this, with these types of leverage, the common denominator is fixed costs, and fixed costs are what will put you out of business. Like I say, if you don't hear anything else I say the rest of this course or before, believe that. Fixed costs will put you out of business. So when you're starting your brand new business, okay, statistically, what's probably going to happen? Now, I know this doesn't apply to you, because you've got the magic touch just like I had the magic touch in my business. Okay, sarcasm intended. Okay? And I'm right in there with you. Okay? But to everybody else out there, not us, but everybody else out there, statistically, what's probably going to happen the first year or 2 or 3 in your business? It's probably going to lose money. Okay? So that, assuming that's true, then to the extent possible, how would you want to structure your costs? Variable or fixed? Variable. Now, after you capture market share and you start enjoying goodwill and all that kind of stuff, then you might want to shift into fixed costs. To the extent possible. And that's what this spreadsheet is illustrating right here. And this is just a reminder illustrating operating leverage. We'll look at financial and combined leverage as well, but just as an introductory reminder, how do I fix this problem right here?
Outstanding.
Outstanding. All right, so what I'm looking at here is the effect of operating leverage. You guys know, how do we define operating leverage? What is operating leverage? If you had me for 34th year, I know you covered it. I'm sure you did in the other two, but if you had me, I know you did.
Is it money you have to borrow to do your operation, to run your operation?
No.
No.
What is the degree of operating leverage? How do we define it?
Degree, oh, I'm sorry. Degree.
Okay. Percentage change in, that's what that stands for, percentage change in. Okay. Percentage change in operating income over percentage change in sales. Okay. That's our degree of operating leverage. Percentage change in operating income divided by percentage change in sales. Okay. And that's what this spreadsheet right here is illustrating. Okay. What we have here is 2009, so we have sales of $1 million. This is a modified income statement as opposed to a real income statement because costs are broken down into behavior rather than classification. Remember we had that conversation, cost of goods sold, fixed and variable, all that stuff? Okay, so this is a modified income statement. But more importantly, notice that between our variable and fixed operating costs, we have $600,000 in operating expenses, which gets us down to an operating income of $400,000. Everybody see that?
Yes.
Okay. So, let's say, to keep the numbers simple for the moment, let's say that we expect sales to increase by 10%. All right, so obviously from $1 million to $1.1 million. Exam question, how much, by what percentage would you expect operating income to change? Well, if, and again, noticing that we have $600,000, so if all of that 600 was variable costs, like we were just talking about when you start up your new business, to the extent possible, if you're able to structure your costs such that they're all variable, then, not surprisingly, if sales go up by 10%, your operating income will go up by 10%. Assuming, remember we talked about variable cost direct proportion, assuming it's a one-to-one relationship, which in the real world, frankly, it probably wouldn't be, if for no other reason than your quantity discounts, your economies of scale. Okay? But for developing the intuition, assuming a one-to-one relationship, we structure everything variable, and then not surprisingly, our operating income goes up by 10%. If they're all fixed costs, so if we have total $600,000 in fixed costs, then if we expect sales to go up by 10%, now our operating income is going up by 25%. And again, that's consistent with the intuition that if all of your costs are fixed, then as you make more and more and more and more and more money, you get to keep more. So far so good? Okay. This is also consistent with what we talked about earlier, which is if we expect good times, then we would want more fixed costs. So you might be, depending on what it is you're analyzing, depending on what you're looking at, you might be able to apply the intuition that if you're on a company and you're from the outside looking in, okay, and you notice that their use of fixed costs are increasing, then what you might be able to glean from that is that
Good times ahead.
they're expecting good times ahead, just like we talked about with their debt-to-equity ratio increasing, or their debt ratio, whichever one you want to use. Okay. Now, you got to be careful because that may not be true. But that, together with other evidence, might lead you in that direction. Okay. So this is good. All right. Well, you guys know that there are advantages and disadvantages to everything. Something that I preach to the 3403 crowd is that when they're doing a deal, business deal, whatever it is they're doing, if everything looks good and there are no disadvantages to it, you probably don't know everything. So keep digging. Okay? Well, this is the good part, but you guys also know that the use of leverage is risky. Because while this is good, of course, the opposite's true. And this is the risk. Okay, so this is just exactly what we were saying a minute ago. You know, in the beginning years of your business, assuming you're expecting to lose money, then you probably want to structure everything variable to the extent possible. Then later on, you structure your costs to fixed. The obvious example of how you could do that would be with respect to if you're running a business, and it would depend on the business that you're running, but assuming you had these people, what's an easy way to switch between variable and fixed costs? I should say obvious, maybe not as easy, but salespeople. Typically, how does salespeople typically get paid one of two ways? That is commission or
Salary.
salary. Commissions are
Variable.
variable costs. Salary is fixed costs.
Fixed.
I had a student several years ago, she came to me, really irritated me. She didn't, but really irritated me. She came to me, hey, I just got a job offer. Oh really? Yeah, tell me blah blah blah. So it was from, I think it was from a brokerage firm or something, but somewhere. Yeah, give me an office computer and all this kind of stuff. And I asked her, I said, well, how much, if you don't mind me asking, how much, did they offer you? And I don't ask that to be nosy. I dealt with people's personal finances for years. I don't care how much money you make. I mean, I really don't. I do it just to keep tabs of the market so that when others come to me and say, hey, what's the market, then I have something to tell them. I don't care how much money you make. I really don't care. But I asked that, she said, well, it's all commission. When I say I don't care, I mean I want the best for you, but I'm not nosy, and I don't care from a nosy standpoint. That's what I mean. But and she said it was all commission, and that really irritated me that a company would try to do that to a brand new college graduate. I mean, and so I had this conversation with her and recommended that she not take the job, and she ended up not taking it, not necessarily because I said so, but for some other reasons. I think she finally woke up that it wasn't a good opportunity, but that really ticked me off. So anyhow, this is operating leverage. So I don't remember what numbers I had in here in the beginning, but getting back to some more realistic numbers. Questions so far? Questions? Okay. How do we calculate our degree of operating leverage? This is how we define it, but how do we calculate it? Anybody remember? Again, if you had me for 34-3, you do it at one time. I think because they always tend to miss these questions on the exam, and I never understand why. Anybody remember? Calculating degree of operating leverage? I'll get you started. Sales minus variable costs over, bless you, sales minus variable minus fixed costs. Okay. Sales minus variable over sales minus variable minus fixed costs. Okay. Questions so far? Questions so far? Okay. So using this example, I have another spreadsheet on here where we have all these calculations, but just while we're here, so using this example, sales minus variable, 850, sales minus variable minus fixed, of course, is 400. Everybody with me? Okay. So that means that our degree of operating leverage would be 2 1/8. So far, so good. What does that mean? 2.125. What's that mean?
Every change in sales, it'll change 2.125.
Okay, you left that one.
For every $1 change in sales.
Not dot, well, close enough. For every percentage change in sales, then operating income will change 2.125. For every percentage change in sales, operating income will change 2.125, which is exactly what you're seeing here. Okay? So if we expect sales to change by 10%, 10 times this gives us 2.125.
technically, we could have just taken if we set up our Excel spreadsheet like that, we could have just taken the percent change in EBIT over the percent change in sales, right?
Yes. Yeah, and that's actually what is in this column right here. Okay. But nonetheless, there's your percent change in operating income. Percent change in sales. Did I do that right? See? Percent change in operating income. Oh, minus 1. Understand that this is assuming you have that second year. So if we're just going off of this year here, then this is all the information that we have right here. Other questions?
Can you explain the if?
Oh, yeah.
in there? Because I don't get it.
Yeah, this is, where do we see that here? E8. So this, if E8 was 0, then what you're trying to do is divide by 0, and you would get an error.
Oh.
So what this formula is called the if-error statement. So what this formula is saying is that, kind of like the if statement, if you get this error, then put in 0%.
Oh.
Okay, and that's what would happen in this case, I think. I actually didn't do, I modified this spreadsheet, but I didn't do the original spreadsheet. But in any case, the answer to your question is, and you see it on another spreadsheet as well, is what it's saying is if this formula results in an error, the most common error is when you try and divide by a 0, then put in whatever's behind the comma, which in this case is 0%. Okay, other questions? Other questions about this? Everybody okay with this right here? No problems with that? Okay. That's good. And the reason I asked that is because a couple of years ago, when we were doing this, they were having a major meltdown over this, and it ended up spawning into an extra credit assignment.
Oh yeah, I'm having a lot of problems.
Well, I say that, but out of a class of 60 or so, only 6 people turned in the extra credit assignment, so it's kind of a double-edged sword. But and their problem was why this equaled that. That was their problem. So since you guys are okay with it, I'll leave that as a cheating for you. All right, so this is operating leverage, and what I was saying at the beginning of this is that notice sales minus variable over sales minus variable minus fixed cost. Notice that the only difference between the numerator and the denominator are fixed operating costs. Okay. So as fixed operating costs go up, the denominator goes down, and therefore degree of operating leverage goes up. So the higher our degree of operating leverage, the more leverage we have in the business, which is driven by fixed costs. Okay? G8? G8. Okay, continuing with the other two, degree of financial leverage is percentage change in percentage change in
EPS.
earnings per share divided by
net income.
EBIT. Percentage change in operating income. Okay. So degree of financial leverage, percentage change in earnings per share divided by percentage change in operating income, which is calculated sales minus variable minus fixed. And by the way, these are operating, this is operating costs, so variable operating costs and fixed operating costs. Over sales minus variable minus fixed minus interest, because interest is a fixed cost source of financing, basically. I mean, before we start getting into variable rate loans and all that kind of stuff. But basically, it's a fixed cost source of financing. What else do we have that would likely fall in that category? Preferred dividends. Preferred dividends, noting that preferred dividends are paid after taxes. So for that reason, so we got sales minus variable minus fixed minus interest minus preferred dividends divided by 1 minus the tax rate. Again, because preferred dividends are paid after taxes, all those other costs are part of calculating your tax liability. So I have all these down here, which we'll get to in just a second. Phil.
How does the sales minus variable and fixed in the numerator for degrees of financial leverage come in the denominator and degrees of operating?
How? Say that again?
They're both,
You're saying how does it go from here to
Right.
here?
and how are they the same? How does the percentage change? How's that work?
Well, I mean, the only thing I know to tell you is that it's a mathematical result, unless you really wanted to start getting into the proof of all this, which is actually the extra credit assignment that I gave out a couple of years ago. But what is it, what's
Well, I'm
the,
just saying, all right, we're saying the percentage change in sales is equivalent to the sales minus variable minus fixed.
ah,
But then we're turning around and
wait,
saying
wait,
earnings
whoa,
per
whoa, whoa,
share.
whoa, 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 is that what we're saying? What Philip just said, if I understood correctly, is that you're saying the percentage change in sales, which is the denominator here, equals sales minus variable minus fixed. And is that necessarily what we're saying? Not necessarily. Because remember, these are comparing 2 years. This is just using 1 year. Anybody else? Is everybody else okay?
Okay, but still, alright, ignore that, I understand that now, but still, how does it become, how are they using that as the denominator for degree of operating leverage, using it as a numerator? You know what I'm saying?
Yeah, I know what you're getting at. I know what you're getting at. Anybody? Want to take it on as an extra credit assignment? And the extra credit assignment would be, I think I used operating leverage. The extra credit assignment would be to submit to me a proof that this does in fact equal that. Proof that, and I mean, we could do the same thing with all 3, but the simplest of the 3, because it has the less variables, is proving that this does in fact equal that. Now, like I said, I gave this 2 or 3 years ago, and 6 people turned it in out of 60. Who wants to do it? Okay. I will post it in the morning, and we'll discuss it after that. Yes.
How much is it worth?
I'll come up with something fair, which will probably be 1 or 2% of your grade. Which is good, because if your grade is on the borderline at the end of the semester, that's the first thing I'll look at to see if you made a reasonable attempt. And the key word there is reasonable. Okay? You can't just turn in, you know, I'm telling you, it's going to take you more than 2 lines to prove this, more than 3 lines to prove this. Okay, so reasonable attempt there is the key word. So I will post that in the morning. What's tomorrow? Tuesday? Probably make it. I'll post all this stuff. Probably make it due on Monday though. I'd like to make it due before the exam, but that only gives you. I don't know. Let me think about it. So we'll take it back up after that. Okay, I'm glad I drew that out. So that's very interesting project. So okay, question about degree of financial level. Excuse me. And you see, those kinds of things are useful because half of you are asleep right now, so if I tell you the answer to that, you're probably not going to remember it tomorrow. But if you actually go and do that, you'll remember it. I promise you, you'll remember it for at least years, if not the rest of your college. This is preferred dividends divided by 1 minus tax rate. Okay, noticing that with financial leverage, the only difference between the numerator and the denominator are fixed cost sources of financing. Okay, so that's why I said at the beginning of all this, the common denominator here are fixed costs. As your fixed costs go up, then leverage goes up, which, if you have a good year, then you're the hero. If you have a bad year, then you're the goat. Okay? So all we're doing here is breaking those fixed costs between operating fixed costs and financing fixed costs. Okay. And so questions about that? Questions? Okay. And then of course the last one, degree of combined leverage, would be percentage change in earnings per share divided by percentage change in sales. So it's just a combination of the two, which would be sales minus variable over sales minus variable minus fixed minus interest minus your preferred dividend term. So again, just a combination of the two. But in the case of combined leverage, we can also calculate it one more way, and that is, anybody remember? I realize you may not have seen this since 34-3, so it's probably been a couple semesters. Anybody remember? If you already have degrees of operating and financial, then you can just multiply them together. Yeah.
On the first one, on
Yes.
the degrees of operating leverage, we have the percentage change in sales as like the sales minus the variable cost minus the fixed cost, but down here, we include those financing ones. Why?
Well, that's directly related to Philip's question, which you will find out in your extra credit,
Okay.
in your proof. Other questions? And fortunately, I've already worked up the answer to the proof, so I don't have to do that all again. But it's actually very interesting. It's a good thinking exercise. Okay. And after I post that tomorrow, I'll probably give you a couple. I'll show you how to get started on it tomorrow. To be fair, last time I did that, some of them didn't really understand what it was I was looking for. And what I'm looking for here is math class. Okay? Remember when you used to do that stuff, kind of stuff in math class? That's what I'm looking for. Okay, on this spreadsheet right here on 6.4 is where I have all of these, an example of all these calculated for you. So we went through what it means. Here's your changes in sales, operating income, net income, and then earnings per share. Okay, so exam question, given that income statement right there, calculate degrees of operating, financial, and combined leverage. But also, make sure that you can interpret it. I mean, the calculation is one thing, particularly with the extra credit assignment, going through the cognitive process of figuring that out is beneficial to say the least, but also make sure you can understand it. Okay? You're running your business, you have a degree of operating leverage of 1.8. I'm running my business, I have a degree of operating leverage of 2.1. What can you say about your business? Yeah, you have less leverage with respect to, and I think I was saying a degree of operating leverage, right? Okay. Yeah, you have less leverage with respect to fixed operating costs. Okay, so apparently I'm sitting on higher fixed operating costs than you. Is that good or bad? And these are all exam questions. Depends on what?
It depends on whose business is expecting to do, right? So if
Okay.
they're expecting to do better, then maybe it is better.
Right. Okay. Yeah, and I was thinking more of it industry-wide, but you're correct. I was thinking more of it industry-wide. But if we're expecting sales to go up, okay, by a significant amount, then I would be at least I would argue that I'd be in a better position. If we're expecting another, 2008, then you would be in a better position. Critical financing decision. Also, like I say, looking from the outside in, this is yet another indicator of risk. Okay, you're looking at buying stocks in two different companies. Well, in addition to all of the other things that you might do to analyze the company, you might want to take a look at their leverages. Okay, one of the things that I've done with some of my companies is look at their leverage going back over 10 years. Okay, is their degree of operating leverage, for example, is it very steady over the last 10 years, or has it been jumping around a lot? Okay. Something else that you can dial into your toolkit.
I'm sorry, can you repeat what you said? You said if it was more leverage, it would be more leveraged in terms of
Fixed operating costs.
operating.
Yeah, if what we were talking about, well, let's look, okay, I think this was yours, and this is mine. So if we had degree of financial leverage, where, I don't know, maybe it was something like that. Now what can we say? What we just said a minute ago was that I was more leveraged than you with respect to fixed operating costs, but now what can we say? In addition to that,
I'm more leveraged.
you're more leveraged with respect to, well, yeah, interest, but more generally, fixed cost sources of financing. Fixed cost sources of financing. So this is getting back into the same conversation that we had with ratio analysis. If you wanted to change these two ratios, probably, this is kind of a loaded question, but probably which one is easier to change? We had the exact same conversation with ratio analysis.
First one?
Operating. Well, yeah, kind of a loaded question. I would argue that in most cases, it's probably easier to change your financing than it is to change your operating cost structure from fixed to variable. It depends on the business. I mean, if you have a lot of salespeople, then it would be, I think it'd actually be easier to do it the other way. But, you know, in general, I would say that it would probably be easier to do this than it would that. Okay? But my point is that just like, you guys all know that one ratio doesn't tell the story. One ratio doesn't tell the whole story about a company. Okay? You need multiple indicators. In fact, I'm just publishing a paper about that right now in a different area, but arguing you need multiple indicators. You can't just look at one and draw a conclusion. Well, here is yet another indicator that you can use for not only determining the risk of a company, but also the source of that risk. Okay. Okay, and like I say, this spreadsheet here has all those examples. So there's your percentage changes. I forget who was asking this, but this is the actual change from one year to the next, which is this right here. Okay, and then down here, I have the calculations. So we're going from 2009 to 2010. So here are your operating financial and combined leverage. Using this stuff here, noticing that I have your combined leverage calculated two ways, which is both this way and this way. Okay? And notice also that for the next year, the leverages change. Which would make sense because your fixed costs are going to stay the same. But your variable costs will go higher, and your sales will go higher, or lower. As your variable costs and your sales will change, fixed costs will not change. So it would make sense that your leverages, your degrees of leverages would change. All right, so again, in summary here, a couple things. Exam questions, calculate, given that calculate the degrees of operating financial combined, but also interpreting it, okay? Mine is 2.1, yours is 1.8. What's that mean? How do you change it? If you wanted to lower your degree of financial leverage, then what would you need to do? So forth and so on. And that boils down to understanding this right here. Okay, I mean, if you want to lower your financial leverage, for example, okay, well, there are lots of ways you can do it, all of which involve either lowering the numerator or increasing the denominator. Well, the only difference are these costs here. So what you're going to need to do is lower one of those two costs. Okay, questions about that? Okay. All right, the other little thing that they throw into Chapter 6, that's, as far as I'm concerned, that's the meat and potatoes of Chapter 6 right there, is the operating and financial leverage. But they also talk about break-even point. So let's make sure we're on top of that. You guys should be bored with this. I don't mean today, I mean you should be bored with break-even by now. One of the things that I'm going to ask you about on the exam is calculating break-even points in units. And how do we do that? How do we calculate the break-even point? Hugely important calculation when you go start your own business. In my opinion, hugely important, even though it's simple. How do you calculate break-even point units?
Sales minus variable cost.
Okay, sales
Selling price
per unit
Right, yeah.
minus variable cost per unit,
Divided by fixed cost.
fixed costs.
Yes.
So total fixed costs, so we'll say total fixed costs divided by unit sales minus unit variable costs. Which we could also write total fixed costs and what's sales minus variable?
Contribution margin?
Contribution margin. So sales minus, or excuse me, fixed costs divided by unit contribution margin. Okay, and in your notes, make sure you distinguish. Over here, we were talking about total sales and total variable costs. Over here, we're talking about unit sales and unit variable costs. Okay. Hugely important calculation for the following reason, in my opinion. I can't have this conversation without, and if you have me for 34.3, you've heard this before, but I can't have this conversation without thinking about the cigar store down on Park Avenue. Remember that? The cigar store down on Park Avenue. I don't even know if it's still there. Does anybody know?
Yeah, it's there.
Is it there? Okay. Now, I don't know really anything about the cigar business. Okay, so the specifics, I don't know. Does anybody work in the cigar industry? Okay. Now, one year I actually had someone who did, well, I mean as a retailer, not as a consumer. Yeah, one year I actually had someone did, and I should have taken that opportunity to get details, but I did. But in any case, they're sitting down on Park Avenue. I would guess, I haven't been there in years, I would guess the size of their shop down there is maybe like 1 1/4, maybe 1.5 times the size of this room, when you consider the back area and everything. How much do you think they're paying a month in rent down there? And I'm out of touch with rent right now, so I don't know. I mean, I don't really know.
8,000.
8,000? Does that seem reasonable? Okay. Which is why this is important in my budget. All right. Well, we'll just say 8,000. Okay. Now, understand, we're talking about just rent, not. This is before you turn on the lights. This is before you pay anybody. This is before you turn on a telephone. This is before you do anything else. This is just rent. All right. They have a whole bunch of cigars down there. Some of them are $1.25. Some of them are 25 bucks. I'm going to assume that most people who walk in there, the average selling price, and this is where we can start getting bogged down in details, but I'm going to say that the average selling price of a cigar down there is, we'll say 8 bucks. Say 8 bucks. I would think it'd probably be more like about 6, but I'll give you a little bit of $8. So that's the average sales price of a cigar. I don't know what cigars are wholesale. What would you guess?
$1.25.
$1.25?
$3.
$3. Yeah, I mean, I would guess about $2. I really don't know. So I'll kind of split the difference between those two and say 2. Okay? So that means, how many cigars do you have to sell each month just to break even? Divide 8,000 by 6. I see a whole lot of laptops there, and I assume they're on Excel, not Facebook. You've got a calculator on your cell phone. I assume you're using the calculator, not text messaging, or Facebooking on your phone.
1,334.
1,334. Okay. So this is selling. So you got to sell, and again, what I'm getting at here is that before you go put your hard-earned money down that you've been saving for the last 10 years, and instead of investing it in a stock, you're going to go start your own business, rest assured that business is an investment. That business is an investment because arguably you could take that same money, dump it into an index fund, and historical returns per year on index funds average about 12%. We're in unusual times now, but as a historical starting point, I think that would be a reasonable expectation of long-term returns. So I would hope that if you're going to go start your own business, you would expect to make more than that. I would hope. Other variables involved, but just focusing on the finances. All right. So you got to sell a little over 1,300 cigars a month just to break even. The question is, in my view, how realistic is that?
Depends how much money they're laundering.
Well, yeah, that's assuming, with the cigar store down there and with Ron John's. I'm assuming they're doing everything legal. Who would go to a surf shop at 3:30 in the morning? Why do they need to be open 24 hours a day?
I lived in Cocoa Beach, I said in the middle of the night numerous times.
Yeah, well, what you do on your personal time, none of my concerns. What you do outside of this class, none of my concerns. I never understood it. I'm sure they're on the up. I'm sure they wouldn't do anything. How many you sell per day? I'll give you Sunday off, so you can work 6 days a week. On average, how many would you need to sell per day?
45.
What'd you get? Well, you've got all this technology right in front of you. How much you got to sell?
We don't know what it is. 43.
Well, I'm giving you
44.
44? Okay.
44.4.
44.9?
4.4.
44. So on average, you got to sell 44 cigars per day. How realistic is that? Okay. Again, I don't know anything about the business, but my point of this is going through that simple thought process. I think is very important. Okay, because when you get down to this, then you might realize, hey, it's not very realistic to sell 44 sticks of tobacco each and every day on average just to break even. Unless we're going to attack the internet. Because if we're selling boxes over the internet, well, a box has 100 cigars in it, I believe. Has 100 cigars in it. So now, if we could sell basically one box every 2 days, now that's kind of a different conversation. So we might want to focus our advertising efforts in internet sales rather than relying on foot traffic. Maybe, maybe not. I mean, that's what you guys decide in business. Okay? But again, my point is, even though break-even is a very simple calculation, it's simple to understand, I think it's a very important calculation. And even sitting here explaining it and discussing it, it still only took, what, 10 minutes to do? Okay? All right, so that's what we have going on here. All right, so we have our same income statement or similar income statement. We have our per unit price, our unit sales, target EBIT, so forth and so on. And dialing in a target to this is relatively easy to do. You guys all know, I hope, that you're not in business to break even. I hope that you know that you're in business to make a profit. How much?
The more better.
Okay. Basically, we would want to maximize profits, although be reminded, goal of the firm, maximizing shareholder wealth. But basically speaking, maximizing profit at a finance majors, at a minimum, how much would we want to make in terms of profit? At a minimum, finance
12%.
majors.
12%?
Which is darn near all of you, huh?
Is it 12%?
Risk-free.
Risk-free rate, yeah.
Risk-free rate. And really, more than that, because this involves risk. This involves risk. Okay?
I'm gonna go broke.
So, my point is that this is calculating break-even, but if we want to dial a target profit into this, then it's very simple to do. We add that to our numerator. What this target profit is the conversation that we just started. Well, what's the risk-free rate? How much of a risk premium do we have on here? Historical large caps, about 12% a year, etc. Okay? All right, so that's what all this stuff is here. All right, so we've got our operating income.